very easy to see all the headwinds that are ahead for the markets. We've got very weak expectations for earnings, and a very strong expectations for a rebound in earnings and also for GDP in the September quarter. And when you have such a large gap down as what we've had in June, it's pretty easy to get some bounces. But it's really the shape of the recovery that matters, Matt. And, when we have gigantic fiscal cliffs in a number of economies, markets priced to perfection, rising COVID case numbers, golly, I can see a lot of headwinds coming to the market in August and September. So, I tend to think the market's due for a pullback at this stage.
Okay, let's talk about the US earnings picture. We've, of course, been going through this over the last few weeks or so, a busy week this week, but the numbers seemingly better than what many were expecting. Have you been surprised by the strength of some of the earnings coming out of corporate America?
Well, I've been surprised in the sense that it's better than feared, but in the end, whether earnings are off 44% or 40 or 35, it's still a horrendous reporting season, reflecting just how grim the outlook was in the early stages of the June quarter. Now, of course, we had reopening, and there has been a little bit more guidance for companies. More companies are reporting upsides in demand, Matt, than those saying that things are getting worse. But all of this is predating the second rise in the COVID infections across the US. The markets focused there on rising case numbers in the South and the West. I'm actually seeing more and more in the Midwest of America and in the Northeast. That, to me, is really threatening the V-shape or the expectations of the V-shaped earnings recovery. And with markets where they are currently in terms of valuations, I think investors need to start focusing on their asset allocation, on their diversification, particularly in a world where bond yields are so low and will probably protect the portfolio much less than it has done so in the past.